Hello, welcome to Accounting 2010 Chapter 9 videos. In video 2, I'm going to discuss the 3 depreciation methods. So what we're going to do is we're going to jump out to the spreadsheets again. And I've set up this problem with Roadrunners. And Roadrunners sells, our little company has started selling so many snacks. We've decided to make our own customized chips, some nice sweet potato chips, some yummy chips. And so we're going to go out and we're going to buy a sweet potato chip machine. The machine cuts the potatoes and sends them through in the oil and even has a bagging mechanism. And so we're going to start selling our own chips. So when we purchased the machine, it cost us $104,000. And we decide that when we're done with it, we can go ahead and sell it to someone else. They're going to come along. Maybe it's a UCD. They're going to decide they want our chip machine, or maybe the Accounting Students Organization wants to have it for their meetings. But somebody is willing to buy our chip machine for, we think, about $9,000 at the end of the life that when we're done with it. So that leaves us with $9,500. That is what the actual cost of the machine will be to us over the life of the machine, the life that we're going to use the machine. And we call that the depreciable cost. That's the amount that we're going to spread out over the number of years or units that we believe we're going to keep the machine. So we decide that we can use that machine for 10 years. And over that 10 years, it's going to produce 250,000 bags of chips. Now these are estimates, and along with estimates we can always make changes in our estimates. That is perfectly fine in accounting if we find that a machine will last us fewer years or more years, if the number of bags we make are more or less, and also if at the end we end up selling the machine for more or less. These are only estimates and they can change. But based on our estimates, we can start to calculate how we're going to allocate the cost of the machine from year to year. And we can choose 3 methods. The first that we could choose is called straight line method. And in the straight line method, we say we want to spread the cost of the machine evenly over the number of years that we're going to use it. The depreciable cost, not the original cost, because we're going to recoup some of that when we sell it. Just the amount that we feel we're going to use up, which is the $95,000. And under straight line, we just simply are going to come up with the depreciable cost. We take cost minus salvage value, and we say we're going to spread $95,000 out over 10 years. And so that's an equal rate. And we know that 95 divided by 10 is equal to $950 a year. 95,000 divided by 10 is $950. So every single year, the expense on our income statement is going to be constant. If a question asks you what was the expense, that is the constant amount. We're spreading the costs, subtracting it from our revenues in order to get to our net income, and that machine costs us $9,500 a year. Now the accumulated depreciation, again, expense on the income statement, accumulated depreciation, that is going to go on your balance sheet as a contra asset account, and it's going to accumulate year after year after year, accumulate or grow, so that when we are taking the cost of our machine and minusing any accumulated depreciation, it will give us what our book or carrying value is. So we've got 104,000 up here minus the accumulated depreciation for year 1 gives us a book or carrying value of 94,500. After 2 years of depreciation, constant 9,500 per year, 2 years the accumulated is 19,000. 104,000 minus 19,000 gives you $85,000. That is the book or carrying value on our balance sheet. And we can do that so on and so on. We're simply going to continue to take the single expense per year, but add the expenses year after year to give the current year accumulated depreciation, subtract the current year depreciation from the original cost, 104,000, to give you that year's carrying or book value. And at the end of 10 years, you will have accumulated $95,000 worth of depreciation, so that when you go and sell that machine, if it does in fact sell for $9,000, it will give you the entire $104,000 value of that machine. Now, another method we can choose is called the double declining balance. And it is very similar, except with just two changes. One, we're going to take, in order to come up with the percentage, we're going to apply twice the straight line rate. It's twice the straight line. So you always calculate the straight line rate. We said the straight line rate was going to be over 10 years. So every year we were going to be depreciating 1/10 of it. Every year is equal to 1/10 of the total 10 years. Twice of that would be 2/10 or 20% a year. That is going to be our rate on double declining balance. Now, if we go down below, there's one other significant change that you must keep in mind. Where we took the original 104,000 and we subtracted out a salvage value to come up with the depreciable value of 95,000, we do not take out the salvage value. We are going to depreciate down to the salvage value. So in this case, we have got in the first year, the formula to calculate the depreciation expense on the income statement is to take the original cost, not that depreciable cost, times twice the straight line rate will give us the depreciation expense in the first year of 20,800. And that 20,800 is going to be the same accumulated depreciation because we've only got 1 year. So we've only accumulated 1 year. If we take the 20,800 subtracted from the 104,000 minus the 20,800 gives us a carrying value or book value on the machine of 83,200. We're going to take that 83,200 and multiply that. If you can see this B2 cell, we're going to take that and times it by that 20%, twice the straight line rate, will give us the depreciation expense in year 2 of 16,640. And if you take 16,640 plus the depreciation of the previous year, you will have accumulated depreciation for those 2 years of 37,440. If you take 37,440 and you subtract that from 104,000, you will have 66,560 as the new book or carrying value. You're going to take that new book or carrying value, move it up here, times the 20%. That will give you your expense for year 3, 13,012. Add year 3 plus year 2 plus year 1 gives you accumulated depreciation of 50,752. And if you take 50,752 from 104,000, gives you a new book or carrying value of 53,248. And you take that 53,248 times twice the straight line rate of 20%. You get the new interest expense for that year. You add all of those together. That's your new accumulated depreciation. The accumulated depreciation subtracted from the original 104,000 gives you the new book value, and so on and so on. You are going to be taking that new book value, carrying it up, taking that number times double the straight line rate. That's going to be your depreciation expense on the income statement. You're going to add it to any previous years of depreciation. That's your accumulated depreciation. And the original cost minus any accumulated depreciation will give you the new book or carrying value. At the end, you will have to reconcile to see what your final depreciation is. We are going to have to depreciate down to the salvage value. So when you look in your book, note that you may end up stopping your depreciation early because you get to the salvage value before 10 years, or you may get to add additional depreciation on if at the end of 10 years you have not fully taken all of your depreciation. That is a matter for your textbook. The last method I'm going to discuss is the units of production, and this is similar to the straight line method in that we take the number of the original cost, and if you look at this formula of 104,000 minus the ending amount that we believe it was going to be worth, and I believe that was 9,000, not 9,500. So we take 104,000 minus the 9,000, and we divide by the total number of bags of chips or any kind of activity, miles or gallons or barrels or any kind of an activity. We take the total number to come up with a per bag per unit cost. Once we have the per unit cost, we can take the actual number used, and in this case they told us we made 30,000 bags of chips in the first year. We take the 30,000 we actually use times the per unit cost. That will give us our depreciation expense for that year, and we go on and so forth. We've got 25,000 bags of chips we made in year 2 times the per unit cost gave us the depreciation expense of 9,500 in year 2. We add those two together. That's how much depreciation has accumulated, and we can find out what the book or carrying value is to take the 104,000 that we paid minus any accumulated depreciation. So at year 2 we would have 104,000, our original cost, minus our accumulated depreciation, is going to give us a book or carrying value of 83,100. So depending on the method of depreciation that you choose, you will see that your depreciation expense could change from year to year. And this is one decision that you as a manager will have to make when you are deciding how to spread the cost of your longer term or plant assets, your intangible assets, over the expected life of the asset. Again, your book and your homework will give you many opportunities to practice these examples.